Income Tax 2020. Tax software example, Schedule C, taxes, expenses. Come in, relax with Income Tax 2020. Here we are in our Lacerte tax software. You don't need the Lacerte tax software to follow along, although I do believe they have a 30-day free trial, so if you can get access to a promo version or a demo version, it might be a good tool. We're going to be focusing here on the Form 1040, the related Schedule C, and thinking about taxes and the deductibility of possibly taxes related to the business, jumping back and forth from the data input to the forms, to the tax forms, the tax software, helping us to do that more quickly as we run different scenarios. We're going to start off with our filing status at single, Eric Smith being our taxpayer living in Beverly Hills 90210. We have the Schedule C income flowing in at this point, the net income in essence coming to the first page of the Schedule C at the $100,000. We have half of the self-employment tax then being deducted as an above-the-line deduction coming from Schedule 1 to get to the adjusted gross income of the $92,935, the standard deduction at the $12,400, and then we have the qualified business income deduction here to get down to the taxable income, $64,428. We're now going to be going on over to the Schedule C. This is where our focus will be. And we see up top, we have the $125,000 in the income. We're going to be focusing on mainly the taxes and licenses line. Now, normally, hopefully, from just a practical data input standpoint, if we get an income statement from a client and we're trying to input that into, say, the Schedule C, hopefully they have everything well calculated and whatnot in the taxes and licenses line will be on the income statement, and we can just pull over that number and bring it over here. However, there are, of course, a couple state taxes we'll have to think about ourselves, such as the calculation of the self-employment tax, for example. And we might want to be a little bit wary of this taxes line as well to see what would be included in it. In other words, did they include, say, the state taxes for state income taxes in this line item on the income statement that was given to us to input into the business, possibly some state taxes which should not be deductible here, or possibly should be deductible, say, on Schedule A, for example. Or we might have taxes that would be included in here for like real estate taxes, possibly because part of it could be deductible as the home office expense, but possibly part of it should be deductible somewhere else, or possibly not deductible, such as a Schedule A. So we might want to be a little bit wary about, what has been included in this line and, what should be included in that line. So then if we go through our sales tax list, or our taxes list that might be deductible, if we have the federal income tax, remember that's not something we'll typically be able to deduct, even though it might be ordinary and necessary, because we're basically calculating federal income tax. We could have the sales tax for the state. We could take a look at payroll taxes. We could take a look at self-employment taxes. We could take a look at and other kind of taxes we might think about. So let's first think about the sales tax. Now, sales tax can be a little bit confusing because we have sales tax that we pay for normal type of purchases. Remember that if you're deducting sales tax or state taxes on, say, the Schedule A for personal purchases, then that might go to the Schedule A, recalling that if we go then to the taxes line item, we might be able to deduct either basically sales tax or the taxes on the state income tax, depending on what our state is doing for taxation. We're talking here, if we're talking sales tax, we're talking sales tax related to the business, which may then be deductible then on the Schedule C here. But if we're paying the sales tax on line items, on just purchasing things such as like supplies, then of course the sales tax will typically be included in the line item that we're purchasing. So if we purchase supplies, paid sales tax for it, then that would typically be included in the supplies line item. If we purchased, say, equipment and had to pay sales tax for it, then we would typically capitalize the cost of the sales tax with the cost of the equipment and then apply out the expense with the depreciation expense. So when we pay sales tax, it's typically not going to be broken out in a separate line item. However, if we pay sales tax to the state, because the state is charging us sales tax as we make sales, then that's a little bit different, and that's a little bit confusing, because oftentimes if the state is charging us sales tax, meaning we sell usually goods, like we sell actual things, usually that's when the state will charge sales tax. And then typically what will happen is when we make a sale, of course, we will have to collect the sales tax and then we will have to pay it to the state. Now, typically you would think, well, that means that we should get we should get to deduct the sales tax because we have to pay it for federal income tax purposes. But that's not normally what happens, because what happens is we don't usually include the sales line item when we record the sale. In other words, if you recorded it into accounting software, it would look something like this. If I sold something for $100 and then I had a 5% sales tax, 5%, then I'd have to collect $105. If we collected $105 in terms of tax software, we would increase cash or accounts receivable by the 105. We would increase sales or income only by 100. And then the $5 sales tax wouldn't go to the sales line, but it would go to a liability line. Because the theory is it's not us charging that $5, it's the government charging the customer $5 directly. We're just the intermediary. And therefore, we're not going to put it on the income statement. We're going to put it on the books as a liability. And then when we pay the sales tax, we're going to decrease cash and we're going to decrease the $5 liability. That way it never hits the income statement. Neither the income nor the expense side hits the income statement. And so that's why we wouldn't have an expense, because we never included the income when we made the sale. That's typically how the sales tax would work. That's how you record it into the accounting software. Now, you might have a situation where someone's like not using accounting software or something like that, and they included their sales tax basically in the gross receipts line item, and they might do that on purpose sometimes, because you might have a situation where somebody is basically getting 1099s. They're receiving 1099s from the person who they made their sales to, and the person 1099ing them is including the full amount that they had to pay, which would include the sales tax. So in that situation, then the government would be receiving the 1099 with the full sales price, and if you didn't put a income line that's at least equivalent or greater than the number of 1099s that you're getting, the amount that's being reported to the government as revenue, then you might have to deal with basically the IRS is going to say, hey, you didn't report everything that we got on the 1099. So in that case, it might be an exception that you would say, okay, maybe I'm going to include in revenue the full amount of the sales, including the sales tax, and then possibly, if that were the case, then possibly deduct the sales tax down here. The net result on net income, and therefore the net result for taxes in general, should generally be the same, because the net income would be the same if you removed both the income and the expense, or if you included both the income and expense. However, the gross amount of the income and the gross amount of the expenses would change. It would be higher if you included the sales tax in both of them, and lower if you did not. So the general rule is that you would not include it, and most accounting software would not include it. Normally, the 1099s, if you're receiving 1099s for people that sell things, it's usually not a problem, because usually you're going to end up reporting income that's higher than the 1099 amount anyways, and that's not going to be an issue. If you do have a client, however, that is not using accounting software, or and they're recording everything that they receive in sales, then you need to be careful about that. Because typically this number should not be including the amount that was collected for sales tax, and you shouldn't have the expense down below. If you do include, however, for whatever reason, the amount of sales tax in the sales line item, then you would think that it would be fair to have the expense down below. So general rule, not included in either, unless there's some kind of exception. You just want to make sure that you know that the accounting system is set up properly there. So then we have the payroll tax that we talked about a little bit in a prior presentation. So remember, if you have employees, we're not talking about the self-employment tax for the owner of the sole proprietorship, but the payroll taxes. So if you had wages down here, then you might have some of the payroll taxes that would be broken out up top. We talked a little bit about that in prior presentations. Just remember that the payroll taxes do not include the payroll taxes that the employee paid out of their wages. Those are included basically here as a deduction for wages. And then the payroll tax, like Social Security and Medicare and possibly federal unemployment tax that the employer pays over and above the cost of the wages, that's what should basically be broken out and put up here as basically taxes separate than the wages. So we should generally have another separate line item for payroll taxes. But again, note that a lot of accounting software like QuickBooks we'll group payroll taxes and payroll expense into one line item. And if you just enter that one line item into the system, it'll probably be here under wages. And that's not exactly the way you'd want to do it. You'd like to break out the payroll taxes, but the bottom line would in essence be the same. Just remember that with payroll taxes, you also basically want to typically tie out the payroll taxes and the payroll to the payroll tax forms, that being the W-3, the 1099, the 941s, and the 940, because those are being reported to the IRS as well. So we talked about that a little bit more in the payroll area. Now, we could also have self-employment tax. That's going to be calculated on the bottom line, basically the net income of the Schedule C. We talked about this a little bit in the past as well, so we'll just kind of touch on it because it is basically another tax. So this is a federal tax, but it's not federal income tax, Social Security and Medicare. It's basically the same kind of tax that we talked about with the wages up top, but that Social Security and Medicare would be based on something that the employee earned, right? The employee had earnings. We had to pay payroll taxes on their earnings. That's what we included up top here for Social Security and Medicare, that we had to pay based on the employee's earnings. We also have to pay Social Security and Medicare basically on our net income, basically our earnings, because we are not included as an employee up top, but the IRS still thinks that we need to be paying basically Social Security for both, or equivalent to, the employee and employer portion of Social Security and Medicare. So now we got this $100,000, which we're going to calculate the Social Security and Medicare on, and then we might be able to deduct basically half of it, but we can't take the deduction up top because it would then create a circle reference. We would then change the $100,000, which would then change the calculation of the self-employment tax. So that means the self-employment tax is calculated with the Schedule SE based on that $100,000, getting down to here, that $14,129, which is going to be included on the second page of the 1040, as we saw before. And we're also going to say on Schedule 1, we get a deduction of half of that. So the $7,065 is half of the self-employment tax. In essence, that's the general rule, which will flow into the first page of the 1040 right there. So that $7,065 is basically based on the Schedule C, taxes related to the Schedule C, which is the self-employment tax, which is having an impact then on the adjusted gross income. So that's going to be the self-employment tax. Then we might have taxes, say, on the vehicle. We talked a little bit about the vehicle before. Just remember that if you have taxes on the vehicle, then that might be included in the car and truck expenses here that you would have. And you also want to be thinking about the breakout between the personal and the business expenses, and you might be using a mileage method versus the direct write-off method. So we talked more about those items with the car and truck expenses. You could also have taxes imposed on property. So you could have like some kind of property taxes that could be imposed on like equipment. If the equipment was used exclusively for business, then you would think you'd be able to deduct taxes and licenses and whatnot that are exclusively for the business. If you have real estate tax, basically on the home, for example, then the home, you might have a business portion with a business using a business portion deduction of the home. And in that case, you might have to break out some of the taxes. Now, if that happens, notice that the client might have put all of the taxes into this line item on their business income statement. And you would then have to make the adjustment noting that it had been included there, or they may not have included any of it in that line item. And again, you just got to know if it has been expensed or not, so that you can make the proper adjustment as you allocate it between business and personal. That would be done with a home office type of deduction. So in that situation, we may be using then Form 8829, expenses for business use of your home. And so we could have a deduction, say, down here, and this would be allocating typically or classically or traditionally based on like the square footage or the percentage of the home used for business versus the personal use. And then we would allocate our expenses out, possibly looking at line 11, real estate taxes, and then we'd have the indirect expenses here, and we could jump then to the data input. And so I've just put some information in here, and then if we pulled over, then we might say, okay, it's an indirect expense, and we might be breaking out then in some way, shape, or form between the taxes that would go on the Schedule C, and if we're able to take the Schedule A deduction, then we may have some portion that's going to flow into the Schedule A. So this is just an example of how we may need to do some kind of breakout such as that to allocate between, say, the Schedule A and because we have some personal use and some business use for the home and the taxes related to it. And then you could see on the Schedule C, that's basically pulling forward basically down here rather than be on the taxes line. So that's something that we'd have to be aware of. And again, if you did something like that, you'd have to be careful to see that the line item that's being given to us for taxes does not include the real estate taxes, because we're going to basically be picking it up down here. And if we have it up there too, we'll have it basically doubled up in that case. So you want to be careful of what's kind of included in this taxes line. Does it include, state taxes that were paid that should possibly be on the Schedule A? Does it include real estate taxes that possibly we need to be breaking out here? Does it not include the real estate taxes that then we need to be breaking out, and we have to ask for the real estate taxes to see how that breakout will work? And so those are some of the typical type of questions you might have related to taxes and the data input and with a Schedule C type of business.